The market's irrationality may be coming to an end in 2026, as the long established 60/40 rule is projected to be reinstated this year, as well as Bitcoin and cryptocurrency as a whole taking a large plunge in what analysts are calling both an earnings call and a move towards AI infrastructure hopes. Also, we dive into the recruiting woes of the labor market and how Target is attempting to redefine itself after the appointment of new CEO Michael Fidelki. My name is Matthew White, joined by my co-host Nyamki Buchanan, and this is Road to Riches. Welcome back, everyone. So today we're going to tackle a couple stories that have a lot to do with our current climate, and a lot of lessons behind them. Story number one is how the 60/40 rule has been it's been in a little bit shaky territory since 2021. So to remind our listeners, the 60/40 rule is a long established rule. So it's essentially a portfolio spread. So 60% stocks, 40% bonds. And the whole point of that is to try to reduce risk in a portfolio and try to find the right mix of equities and debt instruments to try and increase returns as well as try and mitigate risk as much as possible. And that's on top of diversification of those equities as well. And so we move to an article from Brew Markets in which we see a 60/40% portfolio essentially being declared dead since 2021. And this is because this stocks which can be called growing a little bit too much since 2021. They've been breaking the 60/40 rule a little bit. So growing to 65% or 70%. And so in these large companies who hold these portfolios, they have auto generating and auto balancing formulas to try and like balance out people's portfolios. So what's been happening is because when those portfolios get up to 70%, those uh, those computer generated portfolios, they will sell off those stocks and buy more bonds. And essentially, what this article is telling us is that in the current market, and what has been happening since 2021, is instead of working against each other like they usually do, again, when stocks go up, bond prices usually go down. Uh, they've been working in tandem with one another. In this case, when stocks are sold and used to buy bonds to balance out the portfolio, it ends up increasing demand for bonds and propping up the bond prices as well. And moving forward, though, analysts from Bank of America are projecting that the 60/40 rule is going to be reinstated in 2026. And we're going to start seeing equities not grow as much as they have been in previous years. We're going to see bonds maybe not grow as much either, because they're not being purchased as much as more and more equities are sold. Um, and so, Nyamki, what are your thoughts on this story and its long term effects going forward this year and maybe even to 2027?
Yeah, of course. So, I mean, the first thing I do want to say is I want to clarify a little bit, because the way you talk about it almost makes it seem like the 60/40 rule is some type of federal regulation or something. That's not what it is at all. It's just general, long standing investment slash stock market advice, which is that you want to have, as you said, 60% of your portfolio approximately in stocks, 40% in bonds approximately, and then of course adjust that for how close you are to retirement or otherwise needing those funds. Um, but yeah, I mean, we've seen. massive rallies in the stock market the last 3, 4, 5 years. Ever since we had that large dip back at the beginning of COVID, moving into 2021, there was the initial rebound, and then we've basically been off to the races ever since then. A lot of analysts are saying that this is, a historic, rally for the stock market, really, that we've seen over the last few years. So, with that in mind, as you said, a lot of companies were having higher market capitalizations, higher stock evaluations, and their companies were doing so well that they were taking, as you said, that money and investing it back into other bonds, which then raised those bond prices. Um, that seesaw is not something that is normal, or rather, normally it is a seesaw. As stock prices go up, bond prices tend to go down a little bit. So the fact that we were seeing both of them rise at the same time was not necessarily unprecedented, but definitely rare. So I think it's good that at this point the trend is moving back towards standard wisdom, where we are getting closer back to that regular 60-40 split. I think that moving forward, it'll be a lot easier for you and me and other investors, especially our age, who don't necessarily have the time or flexibility to manage their portfolios on a day to day or week to week basis, to where we can just say, all right, I don't have to worry about rebalancing so often. I don't have to worry about paying a financial advisor to take my money and shift my holdings every couple of days. Now I can just sit back and just let time do what it does best, let compound interest take effect, and watch my investments grow over time. Now, with that in mind, of course, a pretty big thing that we do have to think about it is now that we are starting to see a cooling off of the stock market. Some are even saying that there'll be a recession in the next year or so. Others say not quite. It was Scott Bessent, actually, that I read earlier today, who said that we're actually about to see, even further growth in the economy and the stock market. So, fingers crossed. Let's hope that happens. But at some point, all things that go up must come down. So we just have to, stay the course, focus on the dollar cost averaging, just keep investing every 2 weeks, every month, however often you do it, the same amount or more if you can. Because as we constantly say, time in the market beats timing the market. So just pick your strategy, work with your financial advisor, figure out what works, or your local banker, figure out what works for you, and then just let it ride.
Yes, and I think that an additional point that can be made from the story is that, like you mentioned earlier, all things that go up must come down, and we've seen this throughout history as well, where equities have this period of growth, and unfortunately, it happens, this bubble usually happens about 4 years before something catastrophic occurs. So in 1929 we had this bubble that essentially started at the tail end of 2023 going into or not 1923 going into 1924, of relatively low rates from the Fed. With the stock market experienced extremely large gains that before the crash of 1929 wouldn't be seen again for many, many years later. And same thing happened. Same thing happened for the dot-com bubble, and the same thing happened in the '08 crash. And so we see this pattern of bubbles happening before something, like I said before, unfortunate happens in the market, whether it be a full scale correction or just a small, what is called a profit taking, by investors. And so, like you said, people, especially folks our age shouldn't panic. Continue just because something like that happens. Again, this is your retirement we're talking about. This is your nest egg. So again, like, if something bad happens, it shouldn't worry you too much as far as the value, because chances are, just like we've seen in previous crashes, the value of your equities the value of your equities and your holdings will go up again. But in fact, buy the dip, maybe continue putting money into it, be patient. And so, fingers crossed, like you said, that nothing bad happens in 2026. But if it does, take this as reassurance that, this is take make the most out of what's happening and continue to invest. And also the 60/40 rule is there for a reason. Again, talk to your financial advisor and make sure that you're in a position where you can mitigate your own risk by investing in bonds, investing in corporate debt or government debt, and again equities as well. And I think that, like we mentioned before, this story also kind of reinforces the fact that diversification, is it's not a luxury anymore. These are things that are a necessity in the modern world. You have to be diversified in order to reduce your own risk. And again, it's a necessity. This is the market itself assumes that you, as a rational investor, are going to diversify away your own risk, and the only risk that exists after that is what again systematic. So things that are affected by outside forces, and the exogenous effects or the outside effects of government policy or Federal Reserve policy are your stock portfolio going down or up. And so that's what I think we should also take from this article. Be sure to diversify away risk. And again, like you mentioned, the market will come back to normalcy, and this is just an example of that.
Yeah, yeah. And when you say buying the dip, um, we have a lot of viewers that aren't necessarily, as learned as we are in this space. So people say buying the dip all the time, but what does that actually mean, right? So essentially, when the market goes down and it does have that pullback or that correction where prices go down 5, 10, 15% or more, depending on the issue, um, then that low point in pricing is what we call the dip. So to buy it is assuming you have additional cash laying around. Then at that point, you put more into the market. So that way you can benefit from the, again, correction back to where it was before the dip, but then, also, of course, the future gains as well. So we also call that buying at a discount. And, you can buy plenty of other things at a discount as well. And it's basically, just like a sale if you were to go clothes shopping, right? Let's say that you have a stock tip or you've done the analysis yourself and you find that, say, Walmart right now, and this is not, of course, this is not, investment advice. This is just an example, but let's pretend that Walmart is valuated at, say, $100 a share, but it's currently trading at 95. Well, according to your analysis, Walmart stock is $5 cheaper than what it should be. So if you buy now, then you are buying that stock at a discount. It's the same thing that we're doing with the dip, except it's relying on overall market forces to drive prices lower, rather than some type of arbitrage or information that you have that others may not. But even with these types of corrections, I mean, it's not just the bond market, it's not just the stock market that these things happen in. Recently, Bitcoin has been crashing down. It went below $70,000 for the first time in a very long time, and it's still hovering around there today. Matt, of course, you know a little bit more about crypto than me because you kind of focus on that a little bit more heavily, those alternative investments. But even from what I'm seeing people panic about Bitcoin going so low. People are saying, you shouldn't have invested into it in the first place. This is basically something that happens with these unfounded or unsecured, for lack of a better term, investment products. And to some degree, they are right. you know, as we keep saying, Bitcoin doesn't really have any inherent value. It's all about the supply and demand, and when people start to lose interest in it, then the price is naturally going to go down because there's less of a demand. So, what do you take about this situation, and how can those investors either get out of this situation or hedge against it in case this happens again in the future?
Right. Yeah. So essentially, what I'm getting out of this situation is that number one, investors are taking this is a profit taking opportunity for sure for Bitcoin, uh, which going and that's saying that after looking at the pattern, it's experienced several days of consistent decline, as well as other crypto coins. But Bitcoin obviously is the largest and it's taken headlines by storm. And so what I've noticed is that like I said, number one, this is a massive profit taking opportunity for investors who maybe invested in Bitcoin back when it was at 20,000, and they were able to find some buy contracts for Bitcoin back when it was at 80,000, and they saw the coin dropping. They didn't want to lose out on their ROI, return on investment, and they sold. The second thing that I got from this is that people are losing interest in the asset of Bitcoin and cryptocurrency as a whole. Again, I don't want to be simplistic about it, but it seems like it was a little bit of a fad. It was a little bit like investors, some of them at least, were expecting Bitcoin to just be this next big thing. And once another big thing came about, they were going to ditch that whole thing that they were on about Bitcoin and move on to that next best thing. Like we discussed in previous episodes, people who chase the whale, so to speak, chase the big investors, chase the trends, and of course, everybody wants to get in on it first, so as not to hold the bag while the winners walk away. And in this case, the next big thing seems to be the AI infrastructure. So the oracles of the world, the SanDisks of the world, NVIDIA's, Microsoft's, specifically the Nasdaq, which holds all of these tech related companies in its index, has been growing substantially. And in Nasdaq's growth, we've seen this we've seen this correlated decline of Bitcoin, and again, like I said earlier, other cryptocurrencies, but mainly Bitcoin. And so that's kind of my analysis of it. People are moving on to the next big thing. They're thinking that this AI thing, this AI growth in the stock market is going to take them to heights that Bitcoin took them before. And and I think that also you are right. There is no inherent value with Bitcoin what other than how many people, and it sounds simplistic, but how many people decide to buy into it. There's no backing as far as company that has a balance sheet and an income statement. There's its only backing is literally what people think it's worth by buying and selling it on Kraken or whatever exchange you want. And so there's no company backing it. there's not even any currency backing it, and it simply backs itself. And so, uh, when you get into this area, crypto has always been hard to analyze from an analytical standpoint, uh, and a financial standpoint. It's always been difficult to analyze. But in this case, I think that the best conclusion to come out of this story with is, investors are taking the opportunity to get out while they can. They see it continuing to go down, take their profits, and go on to the next big thing, which is AI. And again, I think that the correlation between crypto's fall and the big tech stocks, like I mentioned before, Nasdaq's rise and historic rise, I should add, is definitely something to look at, for clues as to why this is happening and what's causing it. And again, this is a lesson on how some of these fads can either make or break you as an investor. And the most likely option, in my opinion, that will happen to you is break you. Nobody knows what's going to happen. People just have best guesses, especially when you get into very, 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 very risky assets such as cryptocurrency.
Yeah, yeah, completely correct. And you said something that I think is important to talk about because a lot of people don't understand this either. Right? Is you said that there's no other currency or organization backing it. A lot of people really like cryptocurrency for the simple reason that it's disconnected from any particular government or organization like that. They like the privacy aspect of it, and I think that is, of course, a benefit depending on um, your personal beliefs or whatever activities that you're getting into. But we also can't dismiss the fact that fiat currency itself is essentially worthless as well. You know, we in America up until 1971 we were on the gold standard, right? So every single note that you had was backed by an equivalent value in actual gold that was stored at either our army bases such as Fort Knox or Federal Reserve banks, etc. After that point, when we switch to fiat currency, we don't even have that anymore. We say that the US dollar is backed by the full faith and credit of the US government. And of course, all that means is if you don't accept the dollars, then we're going to either throw you in jail or kill you. So take that as you will, but more or less, that's how all governments operate with their currencies nowadays. Number one, because there's simply just not enough precious metals in the world to support the continued expansion of the global economy, but also because even if there was, the extreme demand for both the fiat currency and the physical metal itself would outpace the value that we actually can assign to it, and then we'd get essentially a hyperinflation environment, where we'd be looking like Venezuela was a few years ago, where you had to bring entire trash bags full of $100 bills just so you could buy a roll of toilet paper. It was literally worth, or it was literally cheaper to clean yourself with the dollars themselves rather than to buy toilet paper.
Yeah, for sure. And this that is why a lot of people liked Bitcoin in the beginning and still like Bitcoin, is because they see it as a replacement possibly for the US dollar, and for currency across the globe. As you mentioned, the United States, while we have, certainly have had an inflation problem, over the past 30, 40, 50 years. So people are getting a little bit tired of the inflationary effects of government spending, things like, the central bank manipulation, things of that sort. And so the fascination with cryptocurrency, uh, it can be related to the fascination with precious metals, although not necessarily the same thing. In that, they're precious metals are still being mined as we speak. But cryptocurrencies, especially Bitcoin, like it's done. There's no more being created. It's still being traded and bought and sold, but it's not like it's a resource that is still being taken out of the ground. Uh, and so, that's kind of the fascination with cryptocurrency. I personally have never been a fan, although I do think that it's interesting to kind of study the psychology of cryptocurrency and the psychology of those who get into it. And they have a lot of valid points. Some of those points I agree with. I've just never been able to get into that. Um, and so, yeah, you can understand where they're coming from, but ultimately, something like this was bound to happen with a very risky asset, such as cryptocurrency. And when you combine risk and expenditure together, as you do with Bitcoin, falling from grace from 110,000 to 70, it makes for a bad combination, and possibilities of a lot of loss if something bad like this were to happen.
Yeah, and none of us want losses, but unfortunately, that is part of the game. So, what do you do when you have a loss? Well, obviously, if things get that bad, you just have to get another job. However, the market's not looking too hot right now for jobs. We've got another article that we're seeing here, where there are so many people, particularly in white collar jobs, that are struggling to find employment to the point where now we are paying recruiters to help them get jobs. The article says right here, landing a white collar job is getting so tough that candidates, not companies, are paying recruiters to match them with positions. Previously, over the years, there has been a kind of mutualistic uh, relationship between recruiters and job seekers, where a recruiter will have a list of 10, 15, maybe 20 positions that he needs to get filled, either with one company or across different companies. And he would then go out and find candidates, whether it's out in public on LinkedIn, whatever the case is, and try to recruit them to these companies to fill those positions. The employer would then give the recruiter either a flat fee kickback or some portion of the recruiter's salary, as a fee, and that's how those staffing companies, essentially got paid, how they made their money, how recruiters got paid. At this point, things are so bad that it's the other way around. We recently had the job support come out, for uh, for last year, and while there were a few additional jobs created, I think the number that we're looking at was only about 20,000 or so total. So I was talking with some other people as well, and even though we are still having more jobs being created, how they actually calculate a lot of these doesn't take into account people that are working multiple jobs or have gotten jobs doing Uber, DoorDash, etc. These gig type jobs. So while things may look good on the outside, where jobs are increasing, or we've produced more jobs, we also have to look at the unemployment rate, and the unemployment rate is not falling uh, in the same way that you would expect from how many jobs are created. And even if it was, there's something else that we need to know, because a lot of people also don't realize that the unemployment rate that is put out by the BLS, Bureau of Labor Statistics, is not just, hey, we have 340 million people in the United States. We're going to toss out the people that are under 18, and then out of the ones that are 18 and over, uh, this percentage is employed, this percentage is not employed. That's not how it works. There are a few different categories that are explicitly excluded from the unemployment rate. If you're what's called a discouraged worker, which is someone that has been out of work for a certain period of time, I believe it's 6 months, then they will remove you from that statistic. So the actual employment statistics are likely a lot higher. Excuse me, unemployment statistics are likely a lot higher than what's actually being shown. I believe the number that is most recent is 2.9% or so unemployment rate. But when you factor in those discouraged workers, when you factor in students, for example, who are not currently working but are about to graduate and may be looking for work, it's February now. People are going to be graduating in late April, May. Some people early June. Those people are going to be moving into the workforce. How difficult is it for them to find jobs? That's what this article is really discussing. Where at this point, as we were saying, things have gotten so bad that if you want a job and you don't have uh, connections within the industry or a network, you don't necessarily have the benefit of being a nepo baby or a beneficiary of corruption, for lack of a better term, then you may be someone who is applying for literally hundreds of jobs and not getting anything. And at that point, what choice do you have but to go work at Starbucks, assuming they'll hire you, or to literally pay someone to help get you placed?
Right. And I think that it's an indictment, this article, that is, it's an indictment of the current labor market. I think it just adds to the pain that, a lot of people are feeling in this labor market. And a lot of people are, feeling the pressures of inflation. They're feeling the pressures of equity ownership, uh, it being too expensive to really own a lot of what you use on a daily basis: homes, cars. uh, it we even hear about these, buy now pay later, uh, products that you can get from Klarna, DoorDash, DoorDash stuff. That was a huge thing that came out, um, in
Yeah, when people are
2024 and
talking
20.
about the
Yeah,
collateralized burrito
uh-huh.
obligations.
Exactly. And these again, collateralized burrito loans. But it's an indictment of the current system, of saying that, yeah, things really really are, too expensive, especially in a labor market where people are having to hire recruiters in order to get a job, which is a wild statement. I'll add, it's usually it's the companies hiring recruiters to get employees, but in this case, it's the employees getting recruiters to find employment. And um, it it's certainly, pretty hard. I will say, as far as the whole DoorDash thing is, I think that, there's plenty of blame to go around as far as, how hard the economy is, um, in terms of DoorDash. I've never been a huge fan. To be honest, I've seen people in my life who, just who would rather order DoorDash and spend twice the amount of, how much the food would cost for somebody to just deliver it to them, when they live, 2 miles away from whatever place they want to, wherever place they are. And so, in some, like I said, there's plenty of blame to go around, but in this case, this is an indictment. This is not good. Um, and one thing that I've noticed in the labor market specifically is that the demand for jobs is mainly for not entry level or professional level, or rather C-suite level, which is when you get into the CFOs, the COOs, chief officers, things like that. It's really for the people in the middle. So people who have, they've got their 3 years of experience or what have you. They've got, they've already done the entry level and things of that nature. They're not really, they're not really in it. It's not like they started yesterday. It's not like they start. It's not like they're still in entry level. These people have been in the job market for years and have been employed for years. That's where I'm seeing a lot of the demand in the labor market. And I think it's because of a restructuring of, what jobs are needed and what jobs aren't needed, where companies are trying to figure out, where exactly their employees lie. But uh, all that to say, I think this is an indictment of the labor market. I think this just adds to, how bleak our economy is in some areas. Um, and in a sense, it's sad, how people can navigate around it, to try to see the glass half full, or at least try to get it there. How people can navigate this bleak labor market is, keep trying. It maybe do some in person, going door to door to businesses, and literally handing resumes to people. A lot of those problems that you mentioned, a lot of the frustrations is, recruiters are ghosting them online. Businesses aren't getting back in touch with them, and it seems like they're also, competing with bots online, and these bots are automated by other people to get jobs, or at least get job opportunities before any actual humans are able to get in. And maybe this is a reminder that, a personal touch can sometimes go a long way. Go turn in your resume to some people that, some connections that you may know, or completely new people, new businesses that you would like to get into. Um, uh, so, in short, maybe getting off the computer, getting off of these digital labor markets is the answer here. Other than that, keep trying. Don't lose hope. I can say for sure that, losing hope is the worst thing that someone can do, especially when things are bad. Um, it can be hard sometimes, but uh, you got to keep trying. And again, try to put yourself out there in a more personal sense.
Yeah, and I love the solutions that you're bringing into it. We don't want to just complain about what's happening. We do want to try to actually help, ourselves and our viewers. So, you know, sure, I get it. I'm not gonna sit here and act like things are easy. Yes, the job market is hard. Yes, there are few jobs out there. Yes, there are too many applicants. Yes, there are companies that are posting ghost jobs. You know, all these things are happening, but there are always opportunities available. Like you said, you just got to find them. Whether it's going to trade shows and connecting with companies, whether it's job fairs, whether it's just walking into the building. A lot of the things that the older generations said that they did, they said, oh, I just walked in the store and took my resume and said, here, let me talk to the manager. It sounds old fashioned, but those things probably work better now than they ever have, for the
Right.
simple reason that back 30, 40, 50, 60 years ago, everybody was doing that. But how many people do you think in 2026 are walking into a corporate office and saying, "Hey, this is who I am. I saw on LinkedIn that your CEO or your COO is such and such. Is he in today? I'd like to speak with him."
Right. Yeah. I mean, and you and I joke about it, being in the banking industry, about how, oh, we're trying for those 500 plus connections on LinkedIn.
It's a real thing, though.
We're trying to get our connections up.
Yeah.
But in this case, nobody's doing the things that we're suggesting right now, of actually going and connecting with people personally. And I think that that's a real point, because nobody's doing it. We've become so accustomed to either being accepted or rejected digitally. And I've experienced being rejected for positions in person a couple times, and it sucks, but an employer is going to look at that, or at least some employers may look at that and say, okay, well, at least he or she had, the stones to come up and actually get rejected in person, or put themselves out in person. And maybe that would make them want you more. Uh, uh, Online can get very frustrating. The market can be frustrating. It can look hopeless and bleak. And you and I both know that these realities exist online. At but like you said, not very many people, because everybody's online. Not very many people are actually getting out there physically, and and introducing themselves, saying, "Hey, here's my resume," or "Do you have any opportunities?" or things of that nature, and developing relationships. And just as a side note, maybe it helps you get a job, maybe it doesn't. But what it for sure will do is, maybe this person who you introduce yourself to keeps you in the back of their mind for future opportunities, maybe, or hey, think of me if anything ever comes up. Especially if they have your resume on hand or anything like that. Um, and again, just trying to be hopeful about the situation, because there's a lot of negatives in what we just mentioned. You, but as has been a recurring theme, you have to keep trying. You can't lose hope. If you lose hope, then you're already lost. You know, all you need is one yes. You can you And that should motivate you and say, I've been told no so many times, but all I need is one yes. If somebody says yes, then I'm in. If somebody says no, okay, fine. You're not the only business that exists. I can go keep trying. But if you get a yes, then you're in. Then you've got an opportunity, especially an opportunity to go in and prove yourself. And now the real work starts. And um, and so yeah, these connections matter. And I think another thing we're seeing as technology continues to progress is we're starting to realize a return, maybe, to to more personal means of introduction and communication, because of how um, twisted and weird the digital world has become. We're starting to see that, hey, maybe it's not good to be online all the time. Maybe it's good to actually go introduce myself and put myself out there personally.
Yeah, and all of that is completely true. I like to think, and I'm pretty sure you feel the same way, but one of the things about our industry, specifically the relationship management or loan officer side of things, is that because it requires so much of that personal touch, on some level, our positions will always be available. And I'm not saying that to make us sound like we're special. That's not at all where I'm going. But where I am trying to take this is that when we say to utilize your network or your connections, then that is a much broader thing than just, hey, I'm trying to get a job at Microsoft, for example. Who do I know at Microsoft? You know, Number one, keep your options open. If you're looking for a job at Microsoft, you might not get it, but Meta is also another option, or Samsung or Apple, or these other types of companies. So that's one thing, is keep your options open. You can find good positions in unlikely spaces. For example, even though we're both in banking, we still have a very deep knowledge base and experience pool in financial analysis. So if for whatever reason we decided to leave banking, we have opportunities in financial planning and assessment in some, or financial planning and analysis, excuse me, in some other company like a Microsoft or a Meta, or a Google, right? So those are the first options that you have. But going back to my larger point, with your network and your connections, you can find opportunities in unlikely positions. So always be willing to talk to people. Put yourself out there in situations that you don't even think are necessarily professional opportunities. If you're at church, you never know who has a job opportunity, or who has a connection at what other company. Let's say that the person that you're sitting next to on the bus, for example, if you're on public transit, for example, they may have a backpack from their company, and you see that and you use it as an opportunity to strike up a conversation, and then you may find that although they're not necessarily hiring, they know someone who is. A lot of managers and recruiters, they talk to each other, right? So with access to their network, they can put in a lot more work for you than you can do yourself. So every single opportunity that you have to put yourself out there, to gain a new connection, to talk to more people, take that opportunity, because you never know what you might actually gain from it.
Right, exactly. Again, connections are so important. Putting yourself out there personally, and it may give you an edge. Not a lot of people are willing to deal with not just interacting with people, but the fear of rejection is very real when you're in, a marketing position or a position that requires you to go out and get connected with people. And with the topic at hand, the labor market, not a lot of people are willing to deal with being told no, which will, and it will happen. Not all businesses are looking for work. Um, and so, it will happen. You will get told no, but not a lot of people are willing to deal with no after no after no. And it's easy to get discouraged. And I'll take the motivational route and say, listen, you can get told no over and over and over again. But like one of my favorite motivational speakers quite often says, I'm 1 yes away from success. I'm 1 yes away from getting into this industry, from being able to prove myself, from being able to be successful. And you can keep telling me no, and in fact I'll get more and more motivated the more no's I get told, because it just means that I'm getting closer and closer to a yes. And that's the mindset that you have to come at this with. It may or may not be true. I choose to believe that it is true. But whatever you decide to take from that, remember that you are 1 yes away. You are 1 yes away from beating the.
All right, looks like Matt has dropped off there again. Um, but just to wrap up, because we are just about out of time. Like Matt was saying, you are just 1 yes away. Whether it's the person that you meet in the park, or in the grocery store, or whatever it is, that one opportunity that you find to get into your industry is pretty much all you need. Once you're in, you're golden. So take the opportunities to get internships, take the opportunities to meet new people, take the opportunities to network, participate in the trade shows, go to the job fairs, put yourself out there, and you will at some point find exactly what the right role is for you. It may not be the one that you think you want, but it's the one that's going to help you get to where you need and want to be. So, whether it's a company that has to reinvent itself, or you that has to reinvent itself to achieve your goals and get the job that you want, we all have to go through those processes. We all have ups and downs, and we're all getting squeezed at every side, both us personally and on the market, or in the market as well. So reevaluate yourself, reevaluate your companies, reevaluate your portfolios, and figure out exactly what you need to get exactly where you want to go. I'm Niamki Buchanan. My co host was Matt White. From the both of us, thank you very much for watching this episode of Road to Riches. Please like and subscribe to the podcast. New episodes come out every Thursday, and we'll see you there.